Are you exhausted yet? I know I am. I'm so sorry, but this is the stuff you just gotta know, folks. You just gotta know it. So study these presentations, read the text, do the worksheets, take that study guide and know it inside out. You can do it. Now, our last presentation will discuss strategies. And I apologize beforehand because I basically have my own opinions, which of course are the best opinions because they're mine. So remember that you're going to hear a different viewpoint from other investors, and that's good, right? That's good. Some people like chocolate and vanilla, and some people like vanilla, and some people like strawberry. So let's get started with slide 85 and the buy and hold strategy, which is my personal favorite. You use fundamental analysis. What's that? Relax. We started a little bit when we looked at price to earnings ratio and dividend yield, but we're going to do a whole lot more. We use fundamental analysis to identify high quality companies with good growth prospects and the potential for dividends at reasonable prices. There's that term again, value investing. Or some people use the term growth at a reasonable price, which is not a bad term also. So you see value and growth. When people say value or growth, I say yes, let's do both. I love the term that people use for growth at a reasonable price, GARP. There was a wonderful book called The World According to GARP. They made it into a movie, which is, of course, not as good as the book, so read the book. Anyway, hold it for the long term. Now, what's the long term? Of course, that depends on who you are, right? But what your time frame is. But when they asked Mr. Warren Buffett what his favorite holding period, he says our favorite holding period is forever. Now, he's being a little, mischievous here, right? Because nobody lives forever. But still, the idea is it's a business. You forget the word stock. You're investing in a business, and if you owned a shoe shop or a pizza shop or whatever business, a coffee shop, and it was doing well, would you immediately sell it because its value went up 10%? I mean, would you immediately dump it because its value went down 10%? No, you'd hold on to it for the long term and enjoy the fruits of what businesses have been producing for hundreds of years, as Mr. Jack Bogle says. And it's also the strategy that'll keep you from going nuts. This is a wonderful example here. Let me call it up, called Don't Lose Perspective. And here it is, folks. This is the MSCI World Index from 1990 to 1999, 10 years, right? And it shows the month-to-month percentage return of global stocks over a 10-year period. So for investors with a short-term perspective, the market can be unbearably rocky. Right. I mean, how can you begin to predict what's going to happen next month, what's going to happen in 3 months or 6 months? But if you simply take a long-term perspective, this is what it changes to. This chart plots the cumulative average change in the value of a hypothetical $10,000 investment in that same index, the Morgan Stanley Capital International World Index. It also shows how the effects of short-term fluctuations can look quite different when you keep a long-term perspective. So what we want you to do is think long-term. And I think, we've been saying that from the beginning of the semester, right? And so hopefully you're going to agree with me and think that buy and hold is the best strategy out there. But it's not the only strategy. Slide 86. An income strategy, sometimes called equity income. Remember the equity income mutual funds? Emphasize dividends over capital appreciation. Again, sometimes they'll throw the words out. Oh, that's a value strategy. Well, value is in the eye of the beholder, and I like dividends, so yeah, dividends are value to me. But ideally, we look for companies that are growing their dividends because companies that pay consistently growing dividends tend to do well when the market as a whole does poorly and tend to be the best performers over decades. In general, these are appropriate. This strategy is appropriate for conservative stock investors. Remember, we're not talking about politics. We're talking about people who are prudent. You like that word, prudent? I use that word a lot, don't I? Meaning, yeah, we're going to take some risks, but we don't want to take crazy, scary risks that may make us rich or may make us cry in our beer. And this strategy works great with dividend reinvestment plans. Remember them? Automatically buying more shares with your dividends instead of taking the dividends in cash. Stocks, as we just said, stocks which have had histories of consistent dividend increases have often been the market's best long-term investments. Now, the growth strategy. This is another viable strategy and one that is more emphasized by the folks in Better Investing. And we're going to discuss them and their stock selection guide, the investment clubs that they have sponsored since the 1950s. They look for companies that are growing their earnings. Dividends are a secondary concern. We usually see that these stocks have high price to earnings ratios in expectation of higher earnings in the future. Growth stocks are the stars. They're on the cover of Vogue and GQ and Vanity Unfair. Everyone wants to jump on the bandwagon as a company is experiencing strong growth. Subsequently, the stock price is often bid up to very high levels. Typically, these are the stocks that are the riskiest, and when the slightest hint of a slowdown in the growth appears, the stock price is often brutally punished. And as we've mentioned, many growth investors don't just look at the growth, they look at the growth of the growth. And if you've taken calculus, you've learned about the first derivative and the second derivative. And if it's all Greek to you, don't worry about it. In other words, it's high risk. But you know, there are some companies. The last 10, 12 years, these investors have clobbered the so-called value investors. Growth has been where it's at. But if you go back over decades, over the last 100 years, before the last 10, 12 years, value and growth tend to even themselves out, as described by various studies. So we'll see what happens in the future if growth can continue to outperform value as a strategy. Aggressive growth strategy. Now this, folks, this is what we call speculation, short-term trading. The investor aggressively trades in and out of stocks in order to achieve eye-catching returns instead of waiting 3 to 5 years. And we'll discuss why 3, 4, 5 years is a good time frame to think of. Remember we talked about the mutual funds that had a 20, 25, 30% turnover? Yeah. Instead of waiting 3 to 5 years for a stock to move, an aggressive stock trader would go after the same investment return in 6 months to a year or 3 months. Some traders have time horizons in the weeks or days or hours or minutes, but those investors are up against the high-frequency trading firms which trade millions of shares each day at the millisecond level. You know, I think this is the strategy that many people think they're supposed to use when they start investing in stocks. They see the videos or the pictures of the guy or gal with 4 monitors and 3 computers and 3 telephones and just don't do it. It's fraught with perils and drawbacks, not the least of which are the serious transaction costs that can be generated as a result of frequent trading. Stockbrokers, though, simply adore traders who use this strategy and don't say, but Robinhood is free. You already learned that it's not, right? Right, you're getting hit with the spread. Yes, you are. So, are you going to try the aggressive growth strategy? And if you do, I wish you tremendous luck and success, especially tremendous luck, because you're going to need it. Slide 89. Now, here's an investment strategy that's actually a very good investment strategy, but it ain't for everyone. The contrarian strategy is the strategy where you invest in stocks that are out of favor with the market for some reason, as reflected by low price to earnings ratios, low prices compared to their fundamental analysis, which we will discuss in detail in our next chapter. They look for turnarounds, possibly. Contrarian investors actively seek stocks from companies with sound financial statements that the market has undervalued for whatever reason. And here's a famous contrarian who said it very well. I always try to be accommodating. I buy when others want to sell, and I sell when others want to buy. In other words, everybody's running this way towards whatever next big thing, and this guy is going the other way. But being a contrarian is very difficult since historically the market rises about 3 times as much as it falls. So if you're always selling when people are buying, you're very soon going to run out of stocks to sell. And when asked, Mr. Howard Marks, the CEO of Oaktree Capital, a famed contrarian investor, well, what's it like to be a contrarian investor? He said, it's not a steady business. You have to be willing to sit on your hands and wait for panic. Wait until there's blood in the streets. And that's when you swoop in and buy up the bargains. Mr. Warren Buffett is a contrarian investor. He's also a buy and hold, but he waits until things are horrible before he jumps in. He said it one way. He said, look, you're playing baseball or softball. I think he's a big softball fan. And you don't get 3 strikes. You get 1,000 strikes. You can wait as long as you want until the right pitch comes along. And did Mr. Warren Buffett listen to his own advice? Of course he did. In the fall of 2008, he wrote an op-ed piece in the New York Times saying, I'm bullish on America. You should be too. And he was saying, look, I think he likened it to a heart attack. Our economy had a heart attack. And he felt firmly, and he, of course, turned out to be right, that we would recover. And did he put his money where his mouth was? Yes, he did. He bought $5 billion of Goldman Sachs, the investment bank, $5 billion of GE, and $10 billion worth of Bank of America. And did it work out? Oh, yes, they all turned out very well for Mr. Buffett. Indeed. So that's what it's like to be a contrarian. And the vast majority of us putting $50 a month away, $100 a month away through our mutual fund, through our 401k or traditional IRA or Roth IRA, it's just not that easy to be a contrarian. I must confess that a couple of times I was able to pull it off. I would wait for a pullback. In 2008, my buddy and I were absolutely sure that the market's going to crash. We were absolutely sure. I figured 20, 25%. He said, no, it's going to go down more, 50%. Real estate's going to go down 50%. I thought he was crazy. He was right. And so the market fell in October 2008, about 20, 25%. So I took some extra cash that I had been waiting to invest, because I'm mostly just investing every month through the 403b, Roth IRA, and dumped it into an investment that I'd been looking at for a while. And then it went down another 20%. If I had just waited a few more weeks, coulda, woulda, shoulda. So, again, contrarian investing is a bona fide, real investment strategy, but it just isn't easy, especially for the vast majority of us working grunts who don't have $5 billion lying around to jump in and help Goldman Sachs make it through the Great Recession. Now, here are a few that I hope you will stay away from. But hey, you are who you are, and you decide. Sector rotation. You'll hear people talk about investors rotating out of a sector into another sector. And the idea is you buy the stocks in the hot sector and get burnt, and sell the stocks in the stale ones. Well, you have to decide which sectors are hot and are not going to go stale immediately on you, and which sectors are stale but have the potential to become hot. It's every dog has his day, is the saying. But some sectors have been in the doldrums for a long time, and others have been hot for a long time also. And when's it going to turn? Who knows? I think it's just better to buy high quality companies in all sectors and hold them for the long term. Now, momentum investing is another type of aggressive growth investing. You buy stocks as they go up, you sell stocks as they go down, and you also might use techniques that profit when markets fall, when prices fall. And that's called selling short, which we'll discuss at the end of the semester. It's very dangerous. Don't do it. Peter Lynch says don't do it, and who am I to argue with him? This uses the greater fool theory. Somewhere out there, there's a greater fool than I am who will take these shares or whatever I happen to buy, real estate, which in the mid-2000s was happening, and now cryptocurrencies. Somewhere out there is a greater fool than I who will buy what I bought at an even higher price. Buy high, sell higher. And then the last one that I hope you don't use is market timing. Attempting to predict the future direction of the market. Folks, it's incredibly difficult. You saw the graph we just showed about don't lose perspective. Plus, you got to be right twice. You got to be right when the market falls, and then you got to determine when it's going to turn around. So Mr. Bernard Baruch, who was a very famous investor of the mid-20th century, said it best. Don't try to buy at the bottom and sell at the top. This can't be done, except by liars. The same people who said the fish was this big. Yeah, right. So can you identify the risks inherent in each of these strategies? I hope so. But hey, again, tell me how you did. And I actually had one student who, well, actually I had other students, but one I followed and I kept in touch with, who said he's going to do the aggressive growth strategy. He's going to be a trader. He wants to be a speculator. And I warned him, of course, and he said, oh, yes, I understand. I understand the risks. And usually, people doing this don't usually last more than, a month or so, 3 weeks or a month, and then they go, this is for the birds. But he kept it up for a few years, and then he went back. He went back for his master's degree. So, then I haven't talked with him lately, but he says it's a lot of time. It's a lot of time and a lot of emotions that you're trying to suppress. And he kept it up for quite some time. I was really impressed. And he actually did pretty well, But he said, oh boy, there are nights when you just can't sleep at night. Do you want to sleep well? Or do you want to eat well, right? So he was eating actually very well at times. But he wasn't sleeping very well. So there you go. That's what you're up against. And then I had another student, I should say, who was gung-ho. He really believed that he read all these books by one gentleman, and I can't remember the guy's name, and he's really, he is firmly convinced that there are ways to beat the market using aggressive growth strategies. And we had bantered back and forth throughout the semester. And finally, at the very end of the semester, the very last day of class, he asked me, he said, well, do you really believe that it can't be done? I said, look, I never said that it can't be done. I just said it's really, really difficult. And the risk involved is great. I mean, you could lose everything doing this. You could really, he goes, well, I've lost everything. I said, really? He goes, yeah, 4 times. And and the rest of the class just all looked at him, and I just said, 4 times? He goes, yeah, 4 times. And I just thought, can you imagine? Can I imagine going to my wife and saying, Anita, you know that retirement account we used to have? What used to? What are you trying to tell me? So again, It's up to you. Do you want to eat well or do you want to sleep well? And he was unperturbed. He was not going to give up. He was continuing, and then I've never contacted him again since then. So I don't know how it worked out for him. But I hope he makes it onto Wall Street or wherever, or maybe London or Japan or Beijing, and becomes the world's most famous trader. I hope he does. Trader, please. The system typed up trader. I don't want him to be a traitor. So, slide 91. Which strategy is your favorite? Right? Which one do you favor? And of course, I've already tipped my hand and told you to buy and hold is my favorite. I love income growth. It's not that I will never buy a company that's growing, but boy, I sure do love those dividends. And then these other ones, contrarian, good luck. It's tough. These other three, stay away from. And then aggressive growth, what can I say? Best of luck and success to you. And finally, oh my goodness, that's the end of our introduction to stocks. A lot of information, right, dear students? Yes, but you need to know this information. You are you're very close. You are now rising investment gurus. You're going to be very soon bona fide, real, certified, honest to goodness investment gurus. Because, oh my goodness, oh boy. In our next chapter, we are going to start looking at fundamental analysis in detail using what are called valuation models, specifically the dividend discount models and the discounted cash flow models. I know they sound scary, but they're actually very easy to use. The calculations are very easy. And you are going to learn techniques that very few people actually know exist, let alone use them. Now, are they going to guarantee you're a successful investor? No, of course not. But in my humble opinion, they will tilt the odds in your favor towards long-term prudent investing, and providing the world doesn't end, you should do very well. Did I mention there's no guarantees? No, of course I did. See you in our next chapter when we enter the temple of the dividend discount model.